Welcome to the Daily Briefing. I'm Jack Farley. It's Monday, December 7th. Soon, I'm going to be joined by our managing editor, Ed Harrison. But first, with the day's stories, Haley Draznin.
Hey Jack, markets were mixed on Monday. Investors were finding few reasons to drive the Dow and the S&P 500 to further record highs. We saw the Dow slipped and the S&P 500 fell slightly, while the tech-heavy Nasdaq rose. Stocks have rallied in recent weeks on prospects of a development in a vaccine, but a continued rise in COVID cases, a weak jobs report that was out on Friday, and a Saturday deadline to pass a fiscal stimulus bill has investors maybe feeling a little more uncertain today. We're expecting to see legislation by a bipartisan group of U.S. senators later today for a relief package around $908 billion. But thinking long term, there remains a lot of support and interest from institutional investors for companies that are impacted by COVID because the feeling is they will recover. That's why we're seeing a busy December with a handful of companies expected to go public this week and by the end of the year. Private companies that maybe sat out of that market chaos in the early days of the pandemic and were awaiting a final outcome in the U.S. election are now rushing to go public. Airbnb and DoorDash will both debut this week. Also on deck are video game company Roblox, as well as Context Logic, which is the parent company of the online retailer Wish. There's a trend here. They're all based in the San Francisco Bay Area and cater to consumers stuck at home with extra time and cash on their hands. The mindset for investors on these IPOs is not that we're in December of 2020 currently right now, but it's how it's going to look a year from now. Airbnb is expected to debut on Thursday. They hiked their IPO price range today between $56 and $60 a share. That's up from $44 and $50. It's aiming to be valued at as much as $42 billion with intentions to sell 50 million shares. That's more than double Airbnb's most recent private valuation of $18 billion in the early weeks of the pandemic in April. It's also a significant premium to the $31 billion price tag that it had secured during a fundraising round in 2017. Airbnb was initially hit hard by global travel restrictions, but has more recently seen a boom in customers seeking longer-term domestic rentals. DoorDash is also expected to debut this week on Wednesday. They too upped their IPO pricing range to $90 to $95 per share. That's up from $75 to $85. The company plans to sell 33 million shares and could hit a valuation of about $35 billion. Again, that's more than double the private valuation it hit in a June fundraising round after it had seized on the boom in demand for food and meal delivery. Both of the two startups aim to raise a combined $6.2 billion at the top end of their pricing ranges, and this would help bring December's IPO volume to a record exceeding the $8.3 billion record set in both 2001 and 2003. The methods for potential buyers is being conducted differently than it would have in the pre-COVID world. Airbnb and DoorDash executives have been marketing their offerings to potential IPO investors in Zoom meetings and via an online portal rather than in that typical whirlwind tour across the country. Both Airbnb and DoorDash and their respective underwriters will set their final IPO prices in the coming days. Morgan Stanley and Goldman Sachs are leading Airbnb's IPO, while Goldman and JP Morgan Chase are leading DoorDash's. Back to you, Jack.
Thanks, Haley. Welcome, Ed.
Thank you. And Jack, forgive me if I'm a bit slow today because I'm actually on vacation, as you know, today and tomorrow, but I'm making a special appearance for the daily briefing. Could never turn down the opportunity to talk to you.
Oh, I honestly did not know that you were on vacation. That explains why you haven't been responding to my messages. I'm just kidding. Yeah, well, thanks so much for joining us, on your day off. The markets don't sleep, and neither do you. Today we had a day that seems like risk off, with the Dow Jones down, S&P flat, and the Nasdaq up. What did you make of today's market action, and what are you seeing?
Yeah, so I'm thinking about this from a medium to longer term perspective versus the shorter to medium term perspective, where I don't have a whole lot to add value wise. I think this is just sort of piggybacking on some of the comments that I made on Friday to Ash, and I think we can do a little bit of a deep dive into this. There's a lot of froth in the market. I think that my general view from a medium to longer term perspective is that we're starting at a relatively high level in terms of PE ratios, in terms of the overall market. We're at a very high level relative to other periods in time, regardless of whatever metric you're using, whether it's the cyclically adjusted PE ratio, forward-looking, backward-looking price earnings ratios, et cetera. And so the question is how do you deal with that, given the fact that we can potentially look through the wintertime into a period that is a post-vaccine pent-up demand period? And so I want to talk a little bit about that. Use a few vehicles. There's the Smart Money Index I want to talk to you about on that. I want to look at some individual shares that are emblematic of where we are right now, and then maybe use that as context to the conversation that I had with Richard Bernstein. That's the interview that came out today.
Right. Well, let's start right away with the Smart Money Index. What is that, and what are you seeing in it right now?
Yeah, so the Smart Money Index is an index that was created to talk about, where the real money is, the smart money, institutional investors in particular. And the whole concept is that the markets trade on emotion at the beginning of the day, and at the close of the market, they trade less on emotion, but more on real money. That's where the big guys who are not completely emotional are getting into the market. And so the differential between the two gives you the Smart Money Index. Interestingly, we have a chart which shows that stocks are near or almost at all-time highs right now. The S&P 500 is trading all the way up to unprecedented levels. Whereas, interestingly, at the same time, the Smart Money Index is sinking to near lows. So to me, this dichotomy suggests that we're potentially at a point where there's some sort of event which would create a convergence between those two. So a reversion to the mean, if you will. And it's either the Smart Money Index going up, the S&P 500 going down, or the two meeting in the middle because they both move in some direction. Likely, I think that you will see a meeting in the middle to some degree.
Right. Interesting. So I'm looking at this chart now. So when the blue line is at a relatively high level, that means that it's hedge fund managers, to quote smart money, who are piling into these stocks at the last hour of the day. And when that blue line goes down, and where we are now at the about 13,000 level, that means it's the gamblers who are just buying not necessarily buying options, but buying stocks, buying speculative names, who are pushing this market higher. I guess intrinsically, you mentioned reversion to the mean. That makes me think that when the Smart Money Index is low, that bodes poorly for equities. And I think that makes sense intrinsically. But yet, it's been a fact that a hallmark of this year has been hedge funds managers keeping cash on the sidelines. Meanwhile, it's the retail investors who are making money and having a party. What's your view on that going forward?
Yeah, so I mean, the way I'm thinking about the Smart Money Index is that it says you can think of the smart money as when you see a trend down, as you have from September to December, it says that the trading that's happening at the end of the day is more to sell winners. So it would suggest that those who have profited and who can see ahead and who are thinking logically, they're sort of cashing out more so than staying with the market. So it suggests potentially you're at some sort of inflection point. I think it's interesting if you look at the chart that was on screen for the last 52 weeks. Look at that period between December and May. So you were at a medium level in terms of the market, and then you saw a whipsawing in the March timeframe as people tried to deal with the lockdown and understand what was happening. But then at some point, I think it was in late March when the Fed intervened, and liquidity crisis went away, that index, the smart money index, vaulted higher, and it continued to go higher into April, and it sort of stayed in that range all the way to the reopening before it went down a little bit, went back up in August to September timeframe, and then it's just fallen off of a cliff since then. So to me, the price action that you see, the differential between what happened during the initial phases of the lockdown and now is stark in terms of the ability to, if you're thinking about an inflection point, they're almost mirror opposites of each other.
Right. I just had while you were saying what you just said, made me think of something, which is, do you think that the retail traders, they have more, quote, hot money, in terms of they are very willing to sell should things get bad, specifically should macroeconomic data turn bad, as their household balance sheets are being crimped and squeezed. Meanwhile, hedge fund people, when the tough gets going, they want to plow in to get the deals. Do you think that these retail traders are perhaps hot money?
Well, yeah. I mean, the way that I'm looking at it is that it's a momentum type of thing. And I think this is a good point to bring in these two individual stocks that I'm thinking about, because I thought it was really fascinating. I saw that about a week ago today that Tesla, its market cap exceeded the market cap of Berkshire Hathaway for the first time. And so I have the two stocks, four major financial pieces of information on the two stocks here: market cap, the beta, 5-year monthly, the PE ratio, and the earnings per share. So if you look at Tesla as an example, Tesla has a $612 billion market cap, beta 2.15, price earnings ratio 1,236, and earnings per share 52 cents per share. And as you were saying, most of those earnings are credits, tax credits, because we subsidize electric vehicles. So they're not really earning a ton of cash. On the other hand, Berkshire Hathaway is worth less at $536 billion. It has a beta below 1 at 87, and its price earnings ratio is only 15.44, EPS of over 22,000. Now, what I said to myself is, what if, just to stop for a second. So this is what I'm saying is that Tesla is going to the moon. It's definitely a bubble. But you don't want to get in front of that freight train. Some people want to use the greater fool theory. That is that this stock is going up. It's a momentum stock. I'm not in the stock because I think that it's value. It's good money. I'm in the stock because I know that it has a lot of momentum and it has the potential to go higher. So that's to answer your question from before. That's the kind of dynamics that I think that Tesla is showing. And Berkshire Hathaway doesn't show. But let's just look at the two. What if you take that 15.44 price earnings ratio and then you put it onto Tesla? What kind of earnings per share does Tesla have to get in order to justify its $612 billion market cap? What I came out with is they have to make $40 per share. So essentially, the price earnings ratio of Tesla is 80 times the price earnings ratio of Berkshire Hathaway. So they have to go from 52 cents a share, everything else being equal, to $40 a share. So
absolutely.
What's the potential that Tesla can get to $40 per share in 5 years, 10 years, even 20 years? In order to justify its market cap of $612 billion. I think that it's relatively low.
Absolutely. Ed, your line of thinking is very much aligned with Aswath Damodaran, who I saw on CNBC last week, who he was asked to say, what are the three stocks which you think are the most emblematic of this bubble, or stocks that are very overvalued? And the three stocks he's named were Tesla, Zoom, and Peloton. And about Tesla, he said that I'm beyond saying how much I think it's overvalued or what I estimate Tesla to be, because all traditional metrics have been belied by the extreme price appreciation we've seen over the past 2 years. But the question that I ask now, and again, this is Oswald Motorin saying, the question that he asks is, what would have to be true in order for Tesla to be fairly valued? And the answer that he came up with was it would have to have $500 billion in revenue, and it would have to have the margins of an Apple, a Microsoft, a Google. So I think you're saying very much the same thing. You're saying that it would have to earn $40 per share, and not on emissions tax credits, but on cold, hard cash. And that's just not something we're seeing. I will say, Ed, and I'm someone who is, not necessarily disparaging the Tesla vision, but I'm definitely skeptical of its valuation, like many people who are value oriented. I will say that when compared to its peers, Tesla looks like Kraft Heinz or Berkshire Hathaway. I mean, a lot of these pre-revenue companies like Workhorse, like Nikola, like NIO, which the Chinese company, which is up something over 20 times over the past 2 years. Actually, I think a great deal more. So I think a lot of these, Tesla, it does have revenue, and it is the leader in the space. To me, the greatest threat to Tesla is not these other sort of flash in the pan startups, but the legacy automakers, which I know people have been saying that for 3 years and they've been wrong. But I have a long-term view. If I could quickly just mention something. So I was looking at the different prices of electric vehicles today. Tesla was up 7%. NIO was up 5.4%. Workhorse was down 3%. Nikola down 3%. So you're seeing a little bit of a flight to quality even among the punters. And I don't want to disparage them too much. But one stock that was up a tremendous amount today was MP Materials. And it was up 17%. Now, this is not a traditional automaker, but it is a rare earths mine. And there's these two rare earth elements, praseodymium, neodymium, that are used in all electric motors, whether it's Nikola and its lithium batteries, and Howard Klein's got his lithium batteries, or it's Nikola and their or Toyota and their hydrogen-powered fuel cells. Whatever the motor, whatever the company, they all are attached to a motor that requires neodymium, praseodymium. So that is a stock that was just on fire today.
Yeah, very interesting, because it's all part of the same space. Howard Klein, he was saying that he likes things like Albemarle because it's in that space, but it's in the lithium space. He was talking about the company that you were mentioning, saying that it was brought to market via a SPAC, and it's more speculative. I don't think he was exactly overjoyed in thinking that it was good money value. He was thinking Albemarle, as an example, is a much better value if you put the numbers that you have on your company, on his company. There's a huge amount of appreciation you could get over the next 12, 18, 24 months. Yeah.
So I actually interviewed the CEO of MP Materials, Jim Litinsky, and that airs tomorrow. And just in doing research, one graphic I came across was that I think the price of lithium could increase more than the price of praseodymium, neodymium. However, I think the attractive reason to own MP Materials is that it's the only rare earth mine of any scale or integration in the Western Hemisphere. Over 80% of it is mined and refined in China. So that's something that's key to Jim Litinsky's vision as well. I actually I was editorial on your interview with Howard Klein, and I think that both Howard Klein and Jim Litinsky have very compelling visions. If you're someone who you believe in the trend of electrification and electric vehicles, but you don't want to buy these companies trading at valuations that make you want to throw up, then you could go into these mining stocks that are basically the elements of the future that are required in order to build these. Tesla may make money, Nikola may make money. I mean, who knows? But whoever is the winner and whoever is the loser, they're going to be buying lithium from Albemarle. They're going to be buying neodymium, praseodymium from MP Materials. So it's a very interesting space.
And ultimately, at the end of the day, it's not about companies being bad. It's about prices being bad, whether or not the price is reflective of the underlying fundamentals. And I think, going back to the whole thing, the conversation about Tesla, it's definitely, it's a big stretch to get to the underlying fundamentals given the market cap. Essentially, you're going to be getting no return over the next 5, 10, 20 years in order for it to grow into a market cap to trade even similar to something like Berkshire Hathaway, which is where Apple just, several years ago was trading with a PE ratio of 15. So it makes me think about the Bernstein interview that I did today. And that came out today. And he was talking about the rotation trade. Basically, he was talking about value and cyclicals over growth and non-cyclicals. And I think you don't really necessarily have to be, pro or anti the market per se to think that there's a potential move afoot going forward. Going back to that SMI, the Smart Money Index, and then versus the S&P. If you were to have a pairs trade of the likes of Berkshire Hathaway versus Tesla, obviously Berkshire Hathaway being the value and Tesla being the growth stock, I think that over time that's going to work for you. I'm thinking of 4 different company types. There's one which is the large cap tech, and that's usually the FANG stocks. These are the Fab Five, as Richard Bernstein called them. We're talking about Facebook, Apple, Alphabet. We're talking about Netflix, Google, and or rather Amazon. And then on the other side, we're talking about growth company or value companies. And when I say value, energy companies and financials in particular, Richard Bernstein was saying. And then you have the cyclical companies. And cyclical companies, he was saying you want to buy them when they're trading at a PE of 90 as opposed to 9, because that's when you get the pop in the earnings part. It's about the denominator and the numerator at the same time. So
sorry to interrupt. I heard you say that before about you want to buy it at 90 rather than 9. I'm not sure I wrap my head around that yet. Could you break that down a little bit?
Yeah. So when the price earnings ratio is 90, that means that the earnings have dropped so precipitously relative to the price that you have a 90 price earnings ratio. Just to use some basic math, say that the earnings are 10 and the price is 900. So the 10 compared to the 900, you're thinking, wow, this stock is overvalued. But really, that's a stock that maybe has a normalized earnings level of something in the order of 115 or 120. So the earnings have been crushed. They're down 85, 90%. So going from a level of 90 times earnings with 900 price and 10 on the earnings can go to earnings of 120 over 900, and that's less than 9. That's more in the order of 8. And so obviously you can get, if you bought it at 9, you would still make the pickup from there, and then it could continue on from there. So that's what he was talking about.
That makes sense. I think a few of stocks I've studied in the past that have had tremendous downfalls, a company like Valiant Pharmaceutical comes to mind. They tend to have a very good price to earnings ratio right before they tank. And Jim Chanos in his interview with Mike Green was saying that IBM, it looks like a value stock. It's got a price to earnings ratio of 14, 16, something like that. And to someone like me who, 3 to 4 years ago, I was just getting into investing, and I'd say, oh, I want to buy stocks that have a low price to earnings ratio because I like earnings and I don't like paying for it. Well, it's a little bit more complicated. And I don't want to get into Jim Chanos' thesis on IBM here, but yeah, I think that's such an interesting point, not just about the value growth, but about cyclicals, non-cyclicals. I also might add that the FANG stocks are, they are very richly valued, but they are high quality businesses that have proven themselves. Whereas the Zooms of the world, the Snowflakes of the world, the Pelotons of the world, and even the Teslas of the world. Although, sure, it may be more valuable than Berkshire Hathaway. Its founder, its CEO may have a higher net worth than Warren Buffett. But the business model has not proven itself yet. So yes, I like you said a long something and a short Tesla. What was what you said specifically?
I was talking about Berkshire versus Tesla.
Oh yeah,
a potential trade. And where Tesla lies in terms of the stocks du jour, I'm not sure, but you have the bubble stocks, and I think I would probably put Tesla into the bubble stock as opposed to the FANGs. And then you have the FANGs, the large cap tech. Those are the growth stocks versus the cyclicals and the value stocks on the other side. And so being able to pair those doesn't necessarily mean that you're short the market per se, or that you're saying the market will go down. It's just saying that you think that there's a rotation that will happen from these stocks that have been benefiting now to these stocks that will benefit later and over the medium to the long term. And, I started this out by saying that everyone's thinking about the pandemic because we have a hurdle to get over. I was saying to you right before we came on that the UK, they're the first Western country that is taking a vaccine and is really doing something with the vaccine en masse starting tomorrow. And so all eyes are on the UK to find out how that goes, because between now and when they get into gear, there's a gulf that we have to travel. I'll give you an example. That if you look at the Atlanta Fed's GDP now forecast, it's 11.2% annualized growth for Q4. That's huge. Coming down from 30-some%, which was also huge. But that number is going to continue to tank. And it's possible that number could go negative given the shutdowns that we're having. It's certainly the case in Europe that the numbers have been negative. But that's only over a short period of time. So the question is, when do you start making this rotation? All the people who made the rotation in November did really well because the small cap, the value stocks, they really outperformed in November. If we have this bad patch in the United States in particular, can they still outperform? And my answer to that is yes, that the rotation is in full force and it has legs. It will have legs through this bad period and then on to the other side.
Yes, that's a very compelling case. And I might add, and tell me if I'm correct, that what you just said is not necessarily a macro view. You're saying that cyclicals and value will outperform non-cyclicals and growth, but you're not necessarily saying that cyclicals and value will increase. You'll just say that they will perform attractively relative to their counterparts. Is that correct?
Yeah, exactly. And even if you don't take a bullish view on the economy, that is, if you look on the backside of the long, cold winter, and you say that actually growth will be punk, well, that's an economy where we've opened up. We're in a normal situation, so to speak. This whole stay-at-home stuff is going to be less important. So the premium that you're putting at stay-at-home stocks or for is not necessarily going to be there. I think that there is something to be had from making that rotation trade, both in good times and in bad times. And so I think that it's worth taking a look at. And in particular, if you're looking at it from a good times perspective, the question that I have, and this is a chart that I showed you earlier. Let me explain what I'm thinking about with the chart is the cyclically adjusted price earnings ratio. Mm-hmm. It's this chart that ends with 33.4 on the right side of the chart. So that 33.4 number, that's where we are from a cyclically adjusted price earnings ratio. That's over the last 10 years, the earnings, the price compared to those earnings over the last 10 years, the average earnings. 33.4 is basically higher than every single peak that we've ever had, except for during the bubble, the internet bubble. It's higher than the 1929 peak. It's higher than the Nifty 50s peak. So it's enormous, the levels that we're starting from. And even before, if you look at this chart, when we went down to, say, 25 times on the cyclically adjusted PE ratio in March. We were still at 25 every single period except for a brief period during the housing bubble and during the tech bubble, and then during the roaring 20s was below that level. So even at its best, from a cyclically adjusted price earnings ratio, the market is, relatively speaking, highly valued.
I have a question, Ed. When you say cyclically, and I should know this, when it's cyclically adjusted, is that adjusting for growth? Is that adjusting for interest rates? Because I feel like when interest rates are this
adjusted means taking the last 10 years of earnings and getting the average of that. Because what that allows you to do is say that on average, you're going to get at least one business cycle during that 10-year period. And as a result, you're going to go through a bad patch of earnings. So it's not like the example that I gave you with a cyclical that's trading at 9 times PE versus 90 times. Both of those data points will be in that 10-year period, and you can average it out. And therefore, you don't have to worry about where you are in the cycle. So that's what the CAPE is doing for you. It's telling you that I don't care where I am in the cycle. This is a number that I could use at all parts of the cycle. You know, some people have problems with it, but it is good in terms of getting rid of the problem that you and I were just talking about with regard to cyclicals.
Right, right. The thing that pops into my mind instantly when I see this chart is that, oh man, how overvalued were things in 2000? If the cyclically adjusted price to earnings ratio was higher than it is now, and we're at essentially zero interest rates, not zero, but essentially zero, when I don't know what they were at 2000, but they 4 to 7%, something like that. So that's my first reaction. But then my second thought is this is of the S&P, right?
That's right.
Okay, so I think a lot these snowflakes of the world and the Neos of the world, a Chinese automaker, the Nikolas of the world, they are not included in the S&P. I think there are a lot of companies that aren't in the S&P that are, if not pre-revenue, then pre-profit, that are having heavy losses. And the companies that are some value stocks, they have very impaired balance sheets. I actually was reading the Bloomberg credit newsletter today, and the number of companies with negative EBITDA nearly doubled in the third quarter, from 26 in the second quarter to 47 in the third quarter. So that's kind of, for the last section of this conversation, Ed, I want to sort of pick your brain on what do you make of the credit markets? Because the credit markets, on the one hand, what you're seeing in terms of the balance sheet strength is very weak, with these negative EBITDA getting worse and worse. But at the same time, we're seeing this acceleration of the dynamic where record issuance, record low spreads and yield to worst on high yield bonds. I think at 4.39% option adjusted yield to worst spread on high yield. CLO issuance will exceed $80 billion for the year, higher than 2016. So we're having this sort of to say bifurcated would be an ultimate understatement between the strength of the underlying fundamentals and the ease with which people are just throwing cash out the door in order to buy this, these bonds and fixed income products, which don't yield a lot and have a fair amount of risk. What do you think?
So, yeah, I think that's where the rubber hits the road in terms of the short to medium term, where I think that the damage can be done to your investments is in companies that have poor balance sheets in particular. This isn't even talking about the bubble stocks per se. I'm talking about companies that are normal companies that are going to be negatively affected enough, that are close enough to the edge and will be negatively affected long enough so that what we're seeing in the UK with their vaccine rollout wouldn't help them. We've already seen companies like that. Arcadia went bust. Debenhams is another retailer that went bust. People are talking about taking them over. So you want to avoid being leveraged to companies of that nature. And I think that there are more companies like that than we think that there are per se. So that's perhaps where you're going to see the problems, irrespective of the number of companies that are trading for 50, 60, 70 cents on the dollar, there's still others that are, as Boaz Weinstein was telling me, trading at levels that are relatively high compared to companies that have much better balance sheets. Those companies will not do well during this particular 4-month period.
That's really interesting, Ed. I've got a question, which is, how do you value these companies according to how much debt they have on their balance sheet versus their ability to consistently earn money? I'm going to guess that there is a pretty high correlation between companies that are indebted and companies that are, value companies like Ford and GM, which AT&T, which are heavily indebted, and yet, if for a novice investor who's doing a little screening of price to earnings ratio, they seem like bargains, and perhaps they are, or perhaps they're value traps. How can you just tie, as we end this conversation, Ed, can you tie in your theory about, and your thesis about the cyclicals and value versus non-cyclicals and growth? How does that tie into the balance sheets of companies?
Well, I'll use two companies in the growth side as an example. There was, I think, the guy's name was Ravi Sutra, if I'm correct, who was a convertibles analyst back in the bubble days, like 2000, 2001, who said that Amazon, because they had been issuing convertible debt, that given their burn rate, they wouldn't be able to pay back their convertible bonds, and that they could potentially go bankrupt. And a lot of people took this seriously. Amazon's share price was negatively affected by it. Bezos was upset, et cetera. I think that was the beginning of Amazon really deciding, okay, we're not going to just go for growth. We actually now have to show that we can shut off the CapEx, and then we can actually show that we can earn money. That's what happened to Amazon, and they got through that period, and they've gone on to bigger and better things repeatedly, to the point where they're one of the most highly valued companies in the world. 3 or 4 years ago, Tesla was in the exact same situation. And I used that example at credit write-downs, saying that this is a do or die moment for Tesla in the exact same way it was for Amazon, that they have these convertibles, and if they can't show that they can make the grade to the next level, they won't be able to roll over that debt, and they could go bust. So for them, this is their Amazon moment. And they passed that Amazon moment with flying colors, and it was from that period on that they, were off to the races. So a lot of people could consider Tesla the new Amazon. They're thinking of Tesla as the new Amazon. Obviously, it's not really the new Amazon, because there's a huge amount of CapEx, that's required relative to the actual production on an ongoing basis, whereas Amazon's CapEx was growth CapEx. But the point being is that you can be a growth company, and you can still have be imperiled by having a poor balance sheet. It's all about how much cash you have, your cash burn, the debt that you have to roll over. So even if you don't have a lot of debt, you can still, as a growth company, be imperiled by a cyclical downturn. And we saw that in the 2000s when all those internet companies went bust. We saw that with Amazon when they made the grade and were able to power forward. We saw that with Tesla again in the sort of 2017 period, 2018. And so I think that it gives you an example that it's not just about the value companies and the cyclical companies. Even growth companies have these things to take care of. It's cash on your balance sheet. It's your burn rate, and it's also your debt load.
Mm-hmm. I think that's a really good framework. We're running a little bit low on time, so I think we'll have to end it there. But Ed, thanks so much, as always.
You bet. And as always, it's great to talk to you, Jack.
Great. Ed, just real quick, I think, on CNBC, Andrew Ross Sorkin and Rick Santelli sort of had their little clash about, the reopening and stuff. So I don't know if it's going to be you and me, or me and Ash, or Ash and you. But sometimes we're gonna have to get that high drama into the real vision daily briefing.
I don't think we have it in us, Jack.
No, I don't think so, especially at this end of the year.